Hi, Fools. I'm Diego Bullard, an editor on Millionacres, and I'm really excited to be here with Dan Davies, the author of Lying for Money. I read the book and I wanted to interview him because I think this is a book investors should read to understand how frauds happen and what to look out for, because it seems like there's a lot to look out for. So, welcome. Why do you think people are so fascinated by fraud in general? I mean, it seems like, aside from murder shows, fraud shows are like the most popular.
Well, I mean, I can't speak about people in general, but I think the thing that appeals to me is that it's a crime that's done by cleverness. These aren't people who are just kind of hitting someone on the head and stealing their money. There's a little bit of intelligence involved in all of these frauds. And of course, the other thing it has is you don't really see yourself as being potentially a victim of them. So when you hear about a murder, you think that that could have happened to me. But when you hear that someone's stolen $100 million from a bank with a counterfeit securities, unless you're very rich, you don't put yourself in that kind of position. And then the final thing, I think, is that we hear about the ones that have been quite successful, but ultimately failed. You don't ever hear about the really successful frauds. So they're just this magic trick aspect to them. As I was researching the book, all of these stories, you look through them, you see the trick, and then you see the explanation of how it was done. So you're always getting that slight feeling of self-satisfaction where you think, how could someone be so dumb as to fall for that? But of course, you're reading the story and you know how it ends. You don't actually read the story about the stories where the fraudster got away with it.
That's really true. I think that was very true in the case of Bernie Madoff in particular. I think a lot of people thought, well, there was a little bit of Schadenfreude about the fact that the people that lost their money were rich to begin with.
Yeah, absolutely.
So when I was reading this book, there's definitely a certain pattern. And I noticed you talked a lot about this snowball effect and how, people seem to get away with the first minor fraud, but then it just keeps building and building. And that's how you get in those situations like a Madoff or something like that.
Oh, yeah, absolutely. The trouble is that this is one of the things that really sets apart fraud from other crimes from an economic point of view. And my own background is economics rather than criminology. So I'm really interested by the fact that if someone's a shoplifter, they can just stop stealing from shops. If you're a drug dealer, then you can usually just stop dealing drugs. If you're an embezzler or if you're Bernie Madoff, then you can't just stop committing the crime that you committed, because the interesting thing about fraud from a criminological point of view is that it's the exact opposite almost of murder in terms of detecting it. When someone's been murdered or a safe's been blown up, it's pretty obvious what's happened, and the mystery is to find out who did it. When you've got someone like Madoff, then once you know that the crime's happened, it's pretty obvious who did it. The fraudster has to conceal the existence of the crime itself. And that actually has some pretty profound implications, particularly in an investment fraud context, because it means that the fraud grows at the same compound rate of interest that's the basis for all of your investments. If as soon as you commit a crime of dishonesty, you're effectively putting a wedge between the true economic books and the public books. And that wedge is going to grow at a compound rate. So if you've got a fund worth $100 million and you steal $20 million of it, then if you're declaring 20% compound growth, like you're a sort of super Bernie Madoff character, then in a few years' time, the public books will have doubled and it'll be a $200 million fund. But even if you never stole any more, the original actual invested capital will only be 160 million. So your gap that you've got to cover up grows at the same compound effect as the rest of the business, and that means it snowballs. And then you get situations like Nick Leeson, who probably initially there was no more than 50,000 US. But by the time it finished, it was in the hundreds of millions of US. It blew up the whole bank. And that guy was weeping tears of joy when he was finally arrested, because it meant that he no longer had to carry on this horrible second job he'd got as a crooked bookkeeper.
Well, I think that's interesting. I think the bookkeeping aspect of it, it seems like you always have to have a crooked accountant on your side to really pull things off.
Oh yeah, yeah. I have a little bit of free spare. I'm going to stop my video and see if that helps.
Okay. All right. So, in addition to that snowball effect, there's also this factor that you talked about, which is that anybody who perpetrates the fraud, it seems to they do it once and then they keep doing it over and over again.
Oh yeah, absolutely. And we let them. I mean, there's two things that go on here as far as I can tell. Firstly, white collar criminals just don't get stopped. People keep giving them second chances, and no one puts them in actual prison. But more weirdly than that, there seems to be a psychological thing that's going on there. With honesty, it's gone, and they will always keep on coming back to the well. And that's, from my mind, one of the, as a short seller, certainly the biggest asset that any short selling hedge fund has is the list of people who've been involved in previous frauds, because they will keep showing up. And when you see the name of a crooked broker or a crooked accountant or a crooked director, you can usually short sell that stock with reasonable confidence that at some point it's going to zero.
Interesting. So, you talked about Charles Ponzi in the book. One of the things I really liked about this book was that you go through all of the original frauds that that happened over time, and I think we all think that these things can't happen again, and yet they keep doing it. But tell me a little bit about Charles Ponzi, because I think Charles Ponzi himself is a lot more interesting than what we think of now as a Ponzi scheme.
Oh yeah, no, he was this crazy kind of character that you only kind of got in the first half of the 20th century. The weird thing actually is I'm starting a minor kind of campaign. I actually launched it on International Women's Day to get them renamed Howe schemes, because there was a lady called Sarah Howe who actually invented what later became known as the Ponzi scheme. Ponzi was not actually, he wasn't only not the first Ponzi schemer, he wasn't the first Ponzi schemer in the town of Boston. It was the early 20th century, it was the roaring 20s, and there were loads of these investment schemes going on. So it wasn't as unusual as you might see today to see someone producing huge investment returns. But Ponzi himself had been involved in a number of fraudulent schemes before. He was involved in a medical expenses fraud in, I think, Louisiana, which caused him to have to leave the state of Louisiana in a hurry. But he showed up in Boston and he told everyone he developed this arbitrage system because there was something called the International Postal Reply Coupons scheme, whereby you could pay for return postage if you were sending a letter to someone in another country. And the prices of stamps set for those international reply coupons effectively defined a system of fixed exchange rates. And since the market exchange rates had moved quite a way, in principle, you could carry out a sort of coupon scheme by buying them in countries where they were cheap and then selling the stamps in countries where they were expensive. In fact, it would never have worked. The system had rules against people exploiting it that way, but there was just enough of a kind of sense of reality to the that people began to accept that Ponzi could start promising effectively kind of 50% returns on your money over 90 days. So, something like 240% compound annual. And the money just flew in. He had some very talented salespeople. In the end, he started trying to buy banks, and that's when he ran into trouble because the Boston authorities at the time were kind of content to see him running this strange investment scheme. It was largely within the Italian immigrant community, who at that time, the establishment in Boston didn't really care all that much about protecting them. But then he started taking over a regulated bank, and people started saying, well, actually, maybe we'd better take something of a look at this guy. And then it all fell apart within a few months.
Well, let's give a little time to Sarah Howe, because I think you mentioned in the book that men are definitely more likely to commit these kind of frauds. But Sarah Howe did do that, and it also brought up something really interesting that you mentioned in the book, which is the idea that women who had money on their own needed a way to make more money, and you had something in the book I thought was interesting about never touching the capital and needing to make money outside of that. So explain a little bit about Sarah Howe and what she did.
As you said, it was kind of exactly the same things that websites talk about these days with financial independence. If you were an unmarried middle-class woman with a sum of capital, you needed that capital to provide you for an income potentially for your whole life. Because you didn't want to be in the situation where you reached the age of 60 and you were out of money and you had to become a seamstress. And so there were lots and lots of fraudsters who preyed on unmarried women, spinsters and widows with a bit of investment capital, and claimed that they could provide them with the sort of 8 or 9% return that was probably needed in order to keep a middle-class lifestyle with the amount of investment capital that most of these, they call them unprotected females in those days, which was quite a term that you don't really hear much anymore. Sarah Howe claimed to be representing the charitable arm of the Quaker religion. No one ever really asked why they might have chosen her, since her previous profession was that she was a sideshow fortune teller. But she ran what was purely and simply a Ponzi scheme. And it was called the Ladies' Deposit Bank. Only ladies were allowed to deposit there. You had to be of good character. You couldn't touch the principal, which is handy for anyone who's running an investment fraud. But you got this huge interest payout, which was like a classic pyramid scheme, all made up of the deposits being put in by new investors. And it collapsed and she went to jail, and she came out of jail and started up an exactly similar scheme. And she went to jail again, then she moved to Chicago and started up this. It took her about 3 or 4 spells in the prison before she realized that her true gift was fortune telling.
Yeah, she's a pretty fascinating story.
Yeah. But I mean, there are all these weird characters, and the strange thing is that it's all very structurally similar schemes that you get coming up year after year, separated by sometimes hundreds of years. There's things going on in biotech today, which I would say are completely recognizable as the same kind of frauds that were taking place in the mining industry during the gold rush. And when you've got something like that, you know that there's very deep economic structures here, which are showing up in different historical contexts time and time again.
Well, that's a really interesting point, because that brings me to my next question. Is in the book you compared the Theranos scandal with gold mining scams, and I thought that was really interesting and in kind of an instructive way for investors to think about biotech in general. So can you explain a little bit about how that works?
Yeah, I mean, surely. I mean, if we take this kind of one level back of abstraction, how would a gold mining fraud work? The way that the gold mining fraud works is that you take in a load of investors' money upfront to dig for gold in a patch of dirt that has no minerals in it, and you keep the investors going and putting more money in by submitting fraudulent geological reports. If anyone wants to know how to do this, by the way, these days the geological test is so sensitive, you just take a file to your wedding ring and you can get enough gold dust to contaminate a mining sample.
Wow.
Yeah. And so now you think about how a biotech fraud works, and it's exactly the same structure. You get investors' money in on the basis of a technology that's just never going to work, or where there's no technology there. You keep sending back fraudulent reports of drug testing. In both cases, everyone's accepted that it's a high-risk issue. Everyone's accepted that it's a small kind of chance of success, but potentially a huge payoff. So either a literal gold mine or a sort of new vaccine therapy or whatever. And you keep them along because you exploit the fact that people are basically investing in something that they don't know anything about. But then the other thing I'd say is, and this is kind of a bit more of a provocative point, is that you only get fake mining frauds in real gold rushes. And similarly, you get biotech frauds usually in very hot areas where there are some genuine medical miracles about to happen. I always don't like to say, stay out of absolutely everything unless you fully understand it yourself, because I don't want to be the guy giving people advice to stay out of the entire biotech sector. Because a lot of what happens with fraud is that you have to ask yourself the question, do I want to avoid every single fraud or do I want to get rich? It's one of those risks. It's something you need to keep your eyes open to, but trying to completely eliminate the risk of dealing with a fraudster, my view is that you don't actually want to totally eliminate it. The optimal level of fraud risk is not zero, same as with any other kind of investment risk.
That's really interesting because, I mean, obviously there's so much money going into biotech right now. There is kind of that biotech gold rush happening, and that does mean that there may be someone else out there who's doing something similar to Theranos that we may not even know about right now, and it may look promising. We may be looking at things that aren't real. That's a real concern.
Oh, absolutely, certainly. And but the way you protect yourself against that is by diversification and by not betting sums of money on any biotech investment that you wouldn't be prepared to lose. So I think the rules for protecting yourself in biotech or mining fraud are in many ways they're just the same sensible rules for success in any kind of investment.
Well, and I think a lot of us assume that once a company is publicly traded, that maybe then it's sort of safer. It has to file with the SEC here in the States. Clearly, that's not the case. We've had stories like Enron. What does someone need to keep in mind, even if it's a publicly traded company, and even if it's been out there for a little while?
I think the thing to keep in mind is that audit is the least profitable thing any accounting firm is ever going to do. I mean, the statement, the joke I tend to make when talking to the dwindling number of accountants who will still speak to me is that companies and investors paying for audits want a Sherlock Holmes service and they're prepared to pay more cold money. And so it shouldn't be surprising that auditors just don't find things. If you look at short sellers, investors in high fraud areas like mining and biotech, the really good people in those sectors, in my experience, have the thing in common that they never take numbers for granted. They always carry out channel checks, they always kick tires and make phone calls because they know that if you really want to find a crooked accountant, then you can print money in any of those fields. So, I mean, I don't want everyone to be kind of paranoid about this. I'd hate to think I was going around destroying the culture of trust in American capitalism. But yeah, audit does not protect you because the amount of work that a genuinely reliable audit would take is something that nobody wants to pay for, given that the vast majority of companies are honest.
It's true. Well, I study real estate. That's sort of my beat. And you talk about in the book about the foreclosure crisis that happened here in the U.S., countrywide loans, and the robo signing, which was just massive. Do you think that could happen again? I mean, we're in a different type of real estate market now, but could that happen again? Would there be a situation in which you start seeing a lot of those really risky loans?
Wow, that's a really interesting thing to think about, actually, because I mean, I always think of that as being 3 or 4 scandals that happened at the same time. So if we kind of think of the thing that really actually did the damage to the wider economy was a real estate bubble, could that happen again? Absolutely. Certainly, it may be we're the generation that's lived through the last real estate bubble there will ever be, but you'd have to say, looking back at the history of real estate, that we probably aren't. And those particular irresponsible loan products, it will take a generation for those to come back. You start looking for financial product scandals literally as you start seeing the people responsible for the last scandal retire or die, because that's where the institutional memory goes, and that's where someone comes up with a bright idea saying, I know how we can make loans more affordable. We'll just put some option arm structures back in there. And there's no one left around to say, hang on, you're recreating an option arm mortgage there. Those things are bad. And so that will happen, but maybe not for a few more years. The specific issue of robo-signing, though, hopefully that's one place where we could have made some progress, because that was related to particular operational problems where you had so many people just effectively packaging loans up into securities without ever making the investment in the capacity to keep track of them and do the paperwork. And I think, a few tens of billions of US dollars worth of fines later, the banks have begun to be educated that if you cut those particular corners, it's a false economy and you're going to end up spending a lot more on solving the problem than the fraction of a cent you saved on every mortgage that you put into the system there. They'll still be cutting other corners, so things like robo-signing will happen in other sectors, but the specific disaster area of the consequences of residential mortgage-backed securities and CDOs, hopefully it might take even more than a single generation for people to forget how badly they got caught in that scandal.
Well, I think that's really interesting too. That idea that we tend to forget history. We tend to forget what happens. We let ourselves be taken over and over again, partly because we at what like you said, once one generation goes, then the next generation is like, oh, this is new. This seems interesting.
Yeah, it's a terrible thing. I mean, I'm working on a proposal for another book at the moment, and I'm dealing with an editor at publisher. And it was only the other week he told me that no one wants to hear about the 2008 financial crisis anymore. It's history. And I think it's, not for me. It feels like it happened only last week. It's fair enough. You're a young guy in your 20s, so it's ancient history for you. And then, 10 years on the time, there will be someone for whom that is as far in the past as the 1970s were for me, and they genuinely won't think about it at all.
Well, that kind of brings me to the last thing I want to talk about too, which is the current booms that are happening. So there's two that I'm really fascinated by. One of them is Bitcoin and everything that's happening there as it sort of moves to legitimacy. And the other thing that's come up really recently is the NFTs, and those have suddenly, like out of nowhere, seemed to really pop up. Both of those things seem like they're really just rife for scandal. What do you think about those?
NFTs are absolutely bizarre. And they've come up during the time when I was editing and publishing the book. Because in the book, I talk about ICOs and coin issues. And those were the big thing like a year or so ago. And at that time, I was making the joke that given how poorly regulated ICOs were, and given how much money people were investing in them, anyone who was carrying out securities fraud was a damn fool, because you could do the same thing for the same money with much less risk in ICOs. And in fairness, the SEC got their act together with respect to ICO regulation, and it's a lot harder to go around effectively carrying out unregulated fraudulent securities interest issuance through the ICOs. But now we've got NFTs, and it's hard to even call an NFT a fraud, because someone will sell you one. You say, what does this give me ownership of? They say nothing. And if they've promised you nothing, then you can hardly come back in 10 years' time when you've lost all your money and said this thing was worth nothing, because that was pretty much in the prospectus. It's very weird to me. And to be honest, without wanting to cast aspersions on any particular person or transaction, this to me looks like a solution to the biggest problem the criminal industry's had over the last 18 months, which is that money laundering became suddenly impossible with the pandemic, because it's no longer possible to have a neighborhood pizza restaurant that's claiming $50,000 of cash takings every week. I was just looking on this morning for one of my consulting clients, and I'm in London at the moment. The UK FCA has a list on its website of 24 companies it knows about that are unlicensed, unregistered for any financial services at all, running Bitcoin ATMs in bars and convenience stores around South London. And to me that says, what's going on with Bitcoin at the moment? All sorts of interesting things, but also it's a solution to someone's problem of how to get hold of a whole load of money that they need to launder. So when you see NFTs going back and forth at valuations just in that range of a few multiples of the suspicious transactions reporting threshold, and that makes me raise eyebrows. That makes me think that there's some kind of criminality going on here. And that usually means that someone's going to come in and step on it. from the regulatory side, and in my view, probably better sooner than later.
Interesting. Because I feel like right now there's so much hype around NFTs, and I feel like a lot of people who may have not bought in Bitcoin when it first came out and now see the valuations for it think, oh well, NFTs might be where I can get in now, and I'm going to have the same trajectory as Bitcoin. But it seems like there's just so many. It's hard to know because there's so many NFT offerings. There's the digital art aspect of it that a lot of people are investing. That sort of seems to me like it's going to be like the Beanie Babies of of the 2020s. I'm not really sure. What do you think about that?
It's so funny you mention that. I was just going to mention Beanie Babies too. Which goes to show that there's nothing new under the sun. When you have low interest rates, when you have low trust in some parts of the financial markets, you get strange investment crazes. One of the things that actually interests me is that there is a considerable historical connection between epidemic disease and investment crazes. The original tulip mania in the Netherlands took place during an outbreak of bubonic plague. And it was a very similar phenomenon to some of the things we're seeing here, which was that you had a load of board merchants in the town of Haarlem. They couldn't really carry on their trade, so they hung around in bars, making increasingly crazy trades in tulip bulb futures because they were shut down for a pandemic. And everyone's in this state at the moment where there's a slight sense of unreality to the economy. You've got quite a lot of people who've been economically horribly hit by the pandemic, but you've also got quite a lot of people whose incomes haven't been affected, but their consumption's gone through the floor. So they've got a whole load of excess savings that don't really necessarily feel all that real to them. And so, bit of a kind of 10-cent theory, but I think that a lot of that is feeding into some of these odd manias and panics that we've been seeing over the last 18 months.
Wow, that is fascinating to me because it makes me think of what we've been having here in the U.S. with stocks that are getting pushed on Reddit. So like GameStop and those other things, and people investing. There's been so much money going into Robinhood for people starting to play with the stock market in that way. And so that's really interesting. Yeah. Was there a connection with the 1918 epidemic and any other was that sort of when the stock market run started to begin, or what do you think came out of that particular pandemic? Is there any connection?
It's kind of hard to tell. There's arguments over that. Kind of hard to tell because there was the First World War going on at the same time as what then called the Spanish flu. Certainly, it was a great time to be in the market in the USA, but a lot of that was probably flight capital from Europe at the same time. The other example that someone suggested to me was that there was a flu pandemic in the 1950s that in some parts of Europe that seemed to be connected with not so much investment, but a huge surge in gambling. So there was a whole load of racetrack and casino gambling there. And as you say, with the kind of Reddit and Wall Street bets, they've got it right there in the name. To a large extent, these things are substituting not so much for investment as for the same kind of thrill that people get out of casino or sports gambling.
That makes so much sense. Well, thank you so much for your time today. And just to wrap up, any sort of one sentence that you could give people to kind of keep in mind as they're evaluating things?
What I would say is I'll give away one of the secrets from the book, which is that if something is growing very fast, it needs to be checked out, and it needs to be checked out in a way that it hasn't been checked out before. Because frauds are put together like stage scenery. They only look good from one angle. If you look at it from a different angle, then often you will see that a fraudster can only make something look good in certain ways. They can't create a real object. So check it out in a way that it's not been checked out before would be my advice.
Perfect. Well, thank you so much. This was fantastic.
Great. Oh, thanks very much, Judy. Have a great day.
All right, you too. Bye.